Today we're going to be talking about the highs and the lows and M's and W's. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. We've had an absolutely huge week on the British pound crosses. Yesterday was an enormous day on some of the pairs. Some traders have messaged me and told me that they absolutely knocked it out of the park yesterday. British pound, New Zealand, huge day. Textbook W formation working into the peak formation from Wednesday's trade. Huge move. We'll review those trades from the week also today. Today we're going to review our simple system, and we're going to talk about M's and W's. We've talked about type 1, type 2, type 3, and just stepping back, and again, other traders still finding some frustration, and the common theme that I think that people are still focusing on is chasing the movements of price when the market heads into that expansion phase after the accumulation, or when the Asian session sets a high and a low, or a low and a high. We want to be thinking, are they working the high or are they working the low? So there's a couple of things that will happen. Obviously the market can sometimes run away in Asia into the Europe-London Open. Typically that will be when we're heading into the highs of the week or the lows of the week. Or if we're in a stop hunt and the market is falling down as the market heads into the next 12 candle window. The same thing applies if it's extending out into the upward direction. We want to wait until the market puts a high in place or a low in place so that we can establish our high and our low. And the one thing to really reinforce is timings. So the market could drop 75 pips, and then all of a sudden in the third candle of the second hour of the Europe 12 candle window, which is our equities hour, it can do an engulfment, which on a 1 hour chart is a pin bar. Does it mean that it's going to reverse and automatically go up 50 pips? No, but what that tells us now is if we're at numbers, and if we look to our left, if there's been a previous session's stop hunt occur in a profitable trade, or if the market is indeed engulfing and locking in that low or the high, timing is critical, as is the number levels. So we talked about 50 pip boxes, understanding that quarter levels are often stop hunt extensions of a range, so they'll trap volume down in a quarter level or up in a quarter level before shifting the market away. And again, yesterday's pound New Zealand, classic example, moving 50 pips away from the high of the previous session before working the low. If we're working the low, the market gives a high, and if they're working the low, we want to be thinking W formation, because that spring candle engulfed the first and second candle of that equities hour. But then we also had structure not only for a measured move, but we had geometry for a bigger range expansion after this market had worked down. It had worked the low, it had worked the low, and then London opened and worked it one more time for that engulfment in the opposite direction. When it's at the low of the day like that, that's our type 3. Our type 3 W formation, type 2 W formation. Type 2 M and W will be at the low for the W or at the high for the M formation. The high of that high and low of the day. Type 3 will typically be, if it was a W formation, the market will have worked up towards the high and come off the high of the day. And if it was a type 1, that market may have extended down 25 to 50 pips before reversing back in the opposite direction. And the same goes for the M formation. So that bigger geometrical structure that builds up over the course of the day or that session gives us our structure for geometry for either a 50 pip move back to the high or to the low, or for a range expansion, depending on, it could be a 25 pip structure, it could be a 50 pip structure. But that structure, if we're in a larger high and low of the week scenario, is what gives us our opportunities for targeting potentially more than 50 pips. So we wait for the high and low. Now, the market, when Asia gives us our 12 candle window, they may put a high in place and they might be working lower. So as they're working lower, we do not have a low of the day in place yet, but they could come down and into that Europe London 12 candle window all of a sudden come up and hit the high for our sell setup going in the opposite direction. So it's always about, are they working the high or are they working the low? If they're working the high, obviously we're looking for that M formation. If it's a breakout prior to our 12 candle window, so again, maybe it's a high of the week setup on a Tuesday or a Wednesday, they've broken out, it's already breaking away. Think what's happening. We're triggering technicals. Traders are chasing the trend with their technical indicators. They're chasing it further and further away, and even if it is a trend trade, we'll still get a stop hunt at some point in that 12 candle window of 25 to 50 pips, even if the market is going to resume that trend. There is no free lunch in this market. So timings are critical. Again, we talk about 8 to 11 p.m., 2 to 5 a.m., and 8 to 11 a.m. New York, Eastern Standard Time. I know people have asked me about their broker times and everything else. I don't know. Google New York, set that on your phone or your watch, whatever that may be. These are the times. People have emailed me and said, well, the equity market's open at this time and not that time. If that's working for you, that's perfect. This is the 12 candle timings that I use consistently day in and day out. 50 pip boxes between 50s and double zeros. Quarter levels will typically be, again, where stop hunts will extend into for trap volume. So as the day is evolving, I will often look at the market and say, are they working the bottom of a box or the top of a box around round numbers, trapping volume in an upper quarter, or have they extended outside of those round numbers for a move in the opposite direction? So they could have extended at the high of the week above double zeros into a quarter range, putting in a peak formation for a reversal, or vice versa off the low of the week and the low of the day. Engulfments and pin hammers. So again, think of the logic of the engulfment itself. We've got volume going in one direction and then a candle that closes completely beyond the previous candle's high or low, locking in that low of the day or that high of the day for a move back in the opposite direction or in the direction of the existing trend. The pin hammer is the stop hunt back into the traders who have potentially already entered in on the engulfment. So that's the one last grab at the cash, shaking out traders who have that trade right. Or if this is at the extreme after a 1, 2, 3 blow off move into a low or into a high, specifically at those timings, usually in the equity hour, that's what locks in the low or the high and is the last stop hunt into an existing profitable area. That's why we have I use a 1 ATR stop loss, and again, that typically is 20 to 25 pips. And if you think about it, if we're getting in long, maybe somewhere around the double zeros, and my thesis is that this is going back in the other direction. If I'm wrong, I'm potentially now caught in a measured move going in the opposite direction. So if that market goes more than 20, 25 pips, it could continue to drop quarter levels and go to the next 50 pip box for more than a 25 pip loss. Taking losses is critical for you to be consistently profitable over the long term, especially when your expectancy is 3 or 4 or 5R to 1R risk. So then we come to our trade management. Now I know people have talked to me and told me they like to use trailing stops and everything else. I don't use that. The reason why is that in a lot of these cases, especially in the 50 pip moves, not in a range expansion trade where we have a measured move profit target, but when we just typically will have a 50 pip stop hunt to a high or to a low of a session, often there will be a pin or a pin or something that often may come back stop hunting into the trend because they know that traders will trail those stops. So you could be in a 50 or a 75 or 100 pip move, and you're trailing that stop and you get 30 pips or 25 pips only to watch that trade continue to its existing target, where they're usually going to stop somebody out who's already in the money, whether that's from London or the previous New York session or from Asia, whatever that may be. So in my experience, especially when I will go to break even, especially when the market clears a quarter level or a high or a low, but I won't necessarily trail or tighten that up until that market closes in around the 40 pip of profit area, especially as it gets closer. I've talked about this before. If that market spends more than 30 minutes at a level without hitting my profit target when I'm up 40 pips, I will usually lock it in and call it a day for that session. Self-management, not counter-trending strong moves, not taking trades outside of my trading plan, not trying to finesse or jump into moves after they've gone, not chasing trades, not getting out early or averaging into a position that's not moving the way that it should. Whatever those scenarios are that you need to filter out. For the most part, I've talked about my best trading is usually when I just put my stop in, put my target in, and I walk away and I leave that trade to play out until a certain time has evolved, and then I will either exit, move my stop to break even, or exit the trade because it hasn't done what it's supposed to do. But often anything else interferes with that trade actually doing what it's supposed to do. So I could sit at the screen, I can move stops, I can adjust my profit targets, all those different things, but at the end of the day, that typically ends up sabotaging my overall results and consistency. So I have a simple system. I can duplicate this every single day, and that's the whole point. I'm not looking to try and chase moves all over the place. I have a couple of simple setups that I look for, and I may miss certain setups that are great trades, but again, my goal is not to try and take as many trades as I can. My goal is to take the best trade setups and trade them bigger each time when I'm able to identify those ones in live time where I have the greatest opportunity in terms of risk reward. Yesterday's a classic example. When those markets explode out of a consolidation in those W formations and we have an existing other longer medium term trend in place on the daily charts or anything else, these markets will explode for huge moves. So hopefully traders, again, tons of feedback, tons of emails, a lot of great comments. Stick to the basics. You know, like we talked about 3 push patterns. It's really simple. Just step back and look at the overall movement of the market. Think about Asia, London, New York, three sessions. It could be 3 hours in one session. London opens. It could be a 3-hour setup. But often you'll see 3 bursts that initially start to expand that range from the Asia high-low. And remember, the number one important thing is, where is the money? Wherever there are existing stops, the market eventually will hit those levels. And when it does break out, we have the 3 things that markets do. They break out and they trend. They break out and they reverse. False break. And they break out and they go into a trading range. So if you keep it simple, we work from the highs and lows. We saw some amazing opportunities yesterday. High and low of the week setups. Thursday, down low on a lot of the pairs. They're working the low, working the low, working the low. If they're working the low, okay, think W. If they're working the high, think M. Reversal. We'll look at some examples of the trades from this week. Again, thank you for a ton of great feedback. Thank you for hitting the like button. Keep the questions coming. Hopefully everybody had some improvements in their trading this week. I'd love to hear what's been happening in your trading. Drop a comment below. Keep it simple. Keep getting better. And may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. We're looking at highs and lows and the M's and W formations. We're looking at the pound New Zealand and looking at Monday. We'll just put put our weekly indicator up there. Monday on the pound New Zealand, August 17th. We have the previous Friday's high of the day. We have our Asian session high of the day as we head into our Europe 12 candle window. And we also have a low of the day. So the question that I'm always asking myself is, are they working the high or working the low? As we head into our Europe 12 candle window, we can clearly see we're inside until the end of our 12 candle window when the market begins to expand through the highs of the Asian session. We're working the high. When we're working the high, I am always thinking M formation. If this market was a strong trend, it would have already broken out and we'd be looking for the pullback continuation. As we head into our gap 3-hour window, the market breaks through the high of the day as well as the high of Friday, giving us a 2-bar engulfment once the market pulls back inside off of the quarter level at 75, before dropping down and going sideways back inside the high of the Asian session, which is our initial high and low of the day, for a 50 pip move down. Now the market pulls back, goes into consolidation, and as we head into our next day's session, again we go back to our simple process. We now have our previous high of the day, which is also our high of the week, which is made obvious by the blue line, and we have our low of the week, which is obviously down on Monday's low. And we talked about the initial balance, the Monday, Tuesday, in a large percentage of cases will end up being the high or low in terms of the level for the week. Now, we're not looking at any other charts currently, but the pound crosses have, a couple of the pairs, especially pound New Zealand, have been in very strong uptrends. I've mentioned this earlier in other videos. I've talked about being bullish on some of these pairs. But as we go and just keep our simple process, coming back to our highs and our lows, as the day begins trading, we have a high prior to the 12 candle window, and once that market begins to trade, we now have a low of the day from that Asian engulfment off the low of the first candle of the equities hour in our 12 candle window. That market immediately trades up, stopping out traders at the high of the week that shorted the Monday evening session high before pulling back. I'll just bring this down. Before pulling back and going into consolidation just prior to our 12 candle window. So just coming back to some simple things. This isn't hindsight or looking at what's already evolved. We're not even seeing this. We have a high, we have a low. The market breaks through to the high in our 12 candle window. So I'm thinking peak formation for the week as we head into our London equities hour. We get our engulfment at the high on the third candle of the London market equity hour. Off of round numbers, the market drops down, goes sideways, similar again to exactly what we saw prior to the US session. The market goes sideways underneath of a peak formation, back inside of the Asian high, before stop hunting back down through not only the lower high of the day, but also back into traders who were long off the Asian session. So again, just looking at the quarter level and visualizing this quarter with all that volume trapped up above the 50 level. The market then gives us so just coming back to are they working the high or are they working the low? The market worked the high before dropping down, going sideways, and giving us a type 3M formation as we headed into the US session 12 candle window. But then the market did something interesting. It worked the low, and gave an engulfment and a pin hammer off of the quarter level in the equities hour for a 50 pip stop hunt back to the high of the day. So not only have we had a 50 pip move down from London, We've also had a 50 pip stop hunt back to the high of the day in the US session. There's our M, there's our W. And then we go into our next day's session. We have our session low and our session high. The market also has given us some lower highs and higher lows as we head into the Asian session. The market in Asia is working the high, pulling back at round numbers at 50, works the high again, pulls back, gives us a redrawn low of the day in our 12 candle window. So again, we know we're in a bigger structure, but the market has given us highs and lows, and then at the end of the Asian hour breaks through that low of the day structure. So we have geometry and it's working the low. But we also have sideways consolidation underneath of that breakout with a pin through down to the numbers. That market goes into consolidation at the quarter level before we see an engulfment and pin hammer at the equities, the last candle of the first hour just prior to the equities open for the breakout pullback continuation. Round numbers, high and low. We have a bigger structure for a measured move now. We're at the high of the week. We've come off peak formations, and that market continues to trade down. That market takes out the low of the week before extending down into that lower 50 pip box with two pins and then an engulfment just prior to our US session 12 candle window. And again, we see that pin to the high, which gives us our lower structure. The market pulls back inside and works the high and breaks through in the US session equities hour for a 50 pip stop hunt back into traders who were short in that London move down. So again, we have potential peak formation low. We have a low of the week. The market gives us a redrawn high and low as we head into the next day's session. We also have a W formation from that reversal. So the market's stop hunted back into traders who were long in the US session. They've worked the low, pulled it back, hit it again a second time, engulfment, pin hammer for the move back through the high of the US session. So we have a breakout. The market gives one push, two push, and then works down into the Asian 12 candle window before giving us a low of the day structure. So we have a high of the day structure and we have a low of the day structure. Even though this is outside of our 12 candle window, the market, as it begins to trade, reestablishes a high of the day setup. The market works down and gives us a new low of the day. Pulls back, works the low one more time, giving us a new peak formation high as we head into our Europe-London 12 candle window. We have one push down, two pushes down, and then a third push down at the London equities hour, and then a big spring engulfment candle taking out not only the high of the day, but we have a smaller geometrical pattern inside of a larger geometrical high and low. This is a low of the week scenario into a peak formation low. So again, just looking at this logically, the market is working down into the peak formations, working down, working down, working down, working down. That's a W setup scenario. They're stop hunting down into peak formations where there are existing profitable trades before shifting away. And again, I always tell traders, when you have an all-in day like this, do not counter trend. These markets will not come back. So not only did we have a measured move of the geometry from the high and low of the day, potentially now in a market this strong, we have geometry for a high and low of the previous day's high as well. And again, people have asked me about the measuring tool. This is just my Fibonacci on MT4, where I have just replaced the numbers with 50% and 100% expansions of the range. And again, just keeping it simple, traders. Some traders have put moving averages in here. That's fine. There's no problem. The problem is that when you're using those other indicators, when they're setting up, when they're working the low in 3 pushes or working the high in 3 pushes, those indicators can also get you chasing moves into the trap. So important just to understand, again, having a thesis. Are they working the low? Are they stop hunting into existing profitable trades? Is there a breakout pullback? Or are they hitting it and not going anywhere? That's when you want to be starting to think M's and W's. And this is a classic textbook type 2W formation at the low of the day on a low of the week peak formation for a massive spring move back towards the highs of the week. So as we head into today's session, we have obviously the previous day's high. The market has given us a low of the day formation. It's pulled back roughly 50 pips from yesterday's high. We now have a peak formation high of the day in place, just below the round numbers. So again, now we will look, they may expand this range still, but when the Europe London 12 candle window opens, what I'm going to be looking for is, are they working the low for a move back through the high and a continuation, or are they working the high, taking out the high, possibly for a reversal on a Friday reversal back, targeting traders who are long off of yesterday's U.S. sessions. So obviously we have stops on profitable trades from the U.S. session and London, but this is a fairly strong move. We'll see if the market pulls back on a Friday, or if they work the low, work the low, work the low for a continuation, or even a breakout pullback continuation. Keep it simple, traders. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.